over the weekend, we've had the re-emergence also of geopolitical risk with Hong Kong protests, war of words between the US and China. How much do you expect risk assets to react to this re-emergence of geopolitical risk?
Well, keep in mind, we climbed a wall of worry last year with heightened geopolitical risk. That's the first thing. And we think, secondly, that it is in neither China nor the U.S.'s interest, given the current economic situation and the desire to build the economy back up, to escalate an economic conflict at this time. That said, there are a lot of forces at work here. There's tech issues, there's trade issues, there's financial regulation issues, and maybe some national security issues. And so it could be volatile as the different sides sort through which buckets they're putting everything in.
And we did see a weekly gain for global equities last week. We're seeing green on the screen today. So to some extent, equities are shrugging off this risk, at least at the moment. Then, of course, the focus turns to the easing of lockdowns. And you've got some really interesting observations in terms of the relationship between lockdowns and virus transmission and whether we actually get a second wave. What's your assessment for that at UBS Wealth Management?
Well, thank you so much, Nayra. I think that, there's a lot about the virus that is not proven, that we're learning as we go. And what we did was we went through some of the mobility data, because you can track now what people, how much of a lockdown different countries have actually had through cell phone data. And what we found is that there's little correlation between the mobility and the success in reducing the reproduction rate of the virus. And so then we try to fit that to the data. And it seems somewhat possible that in some cases, if you look at, say, London, the serology is now showing that maybe 17% of London has already been infected. And that raises questions about, in some of these areas, do we have something like a modified herd immunity? It's a theory, but it might be one of the reasons why we should be less worried about a second wave than some of the historical examples going back to 1918 or the Middle Ages.
Interesting. So if the data in the coming weeks supports that scenario that you've outlined in terms of the diminished risks of a second wave, what does that mean in terms of further upside for equity markets, given the rich valuations we're already at?
Well, I think that there is some reason to believe, given the central bank stimulus and the fiscal stimulus, that multiples could go higher, and markets are forward-looking, so it's forward multiples more on normalized earnings, that the broader indices could trade higher. However, we would look for a lot of the gains to come from the parts of the indices that have not rallied at all. And so we'd be looking more at some of the cyclicals and some of the value names to kind of catch up to where the broader indices are.